There was a lot of noise yesterday about tariffs out of the Trump administration, about reciprocal tariffs. The market perception, to my mind, seems to be that actually this is largely unworkable. Has the market concluded that actually what we got yesterday isn't something that needs to be priced in?
Morning, Guy. Well, I guess it's something that was already more than priced in. Is there another way that you could look at it based on the way that the market reacted afterwards? You know, the fear that had been in the market that there would be, higher blanket kind of tariffs coming in from the Trump administration almost from day one. We didn't get it on day one. In fact, we didn't even get it yesterday, despite the rhetoric around it. We got a promise that it's coming in maybe 6 weeks, maybe longer, which opens that longer window for people to negotiate, along the lines of what we heard from Modi in the meeting with Donald Trump. It also gives you this idea that actually maybe, it's going to be a little bit more thought out or more thoughtful or more sensible or practical or kind of not something that's just done rashly, but is considered, and therefore maybe the market can warm to that idea as well, rather than it being kind of that blanket approach that captures everybody all at once. And so what we've seen is a relief in the idea that it's not coming immediately, that there's room for negotiation, that it's not going to be all that punishing, at least not right away, and that there's wiggle room and that everybody else has time to prepare for it as well. We've got the dollar therefore weakening against the rest of the world's currencies. We've got equities in the US, they popped higher. In Asia, they've been having a good day. Not looking quite so rosy for Europe, which was already optimistic maybe about this. And we also, had a little bit of a drop in the bond yields extending after the Trump press conferences.
Yeah. Well, Paul, you talk a little bit about wiggle room. Let me take that to the next level here. When we do see these headlines come across, specifically when he says that we're going to evaluate on a country-by-country basis, it shows up in the FX space as the clearest trade. Bond markets, equity markets, they take a little bit of a moment, perhaps, to contemplate the consequences of that, as you just laid out. Does that create a dislocation between the bond markets and the FX markets that are traditionally so closely tied together?
Yeah, it's interesting because you've got that layered on top of the sort of relative yield play, which has been the key driver for FX markets for so long now. I think that, yes, the tariffs and that risk is definitely going to hang over markets still like the sort of Damocles, and FX traders is that first line of response, as you say, Kriti. On the other hand, it all sort of comes back to the same idea. If we're going to have lower US yields, we're going to have a weaker dollar, and then the rest of the world is okay with it, because you also have that sort of inflation mechanism feeding through into the bond market. People worried about the idea that higher tariffs, yes, okay, they will punish the rest of the world, but they will also be inflationary for the US, and therefore they will push up Treasury yields and be supportive for the dollar. So it should all ratchet back together more or less, but you also have that premium that is coming in and out depending on the trade tariffs way of responding to it, particularly in those emerging market currencies which are responding so volatile to the moves.